everybody, I am Dr. Jayanti, Professor, School of Management. We are learning foreign trade procedures and documentation. In this video, we shall explore the content on Unit 4 on methods of payment. In today's interconnected global economy, importing goods is a vital aspect of business. In today's interconnected global economy, importing goods is a vital aspect of business operations for companies seeking to meet consumer demand, diversify product offerings, and gain a competitive edge. Import procedures and regulations play an essential role in ensuring that goods flow smoothly across borders while adhering to national and international standards. For businesses, understanding these regulations is crucial for efficient operations, cost effectiveness, and compliance with the legal frameworks. This video delves into the fundamental components of import management, covering essential topics such as financing export transactions, navigating foreign exchange facilities, understanding duty drawbacks for exports, and managing foreign currency accounts. Additionally, we will also explore the specific customs formalities required for the clearance of imported goods and the logistics involved in shipping and handling of exports. Together, these elements form a comprehensive roadmap for navigating the complex landscape of import regulations, ensuring that businesses can successfully manage the logistical and financial aspects of international trade. We shall also discuss about general provisions for imports, financing import, foreign exchange facilities to importers, customers and central excise duty drawbacks in export goods, foreign currency accounts in India and abroad, permitted currencies and methods of payment, and then customs formalities for clearance of import goods, finally the shipment of goods. Let's move on. In an increasingly globalized world, imports are essential for countries and businesses looking to diversify product availability, reduce production costs, and provide consumers with a broad range of goods. Efficient import processes facilitate international trade, fuel economic growth, and enable businesses to tap into foreign markets. However, imports come with various procedural requirements and regulatory frameworks that must be followed to ensure compliance, maintain trade stability, and prevent illegal or hazardous goods from entering the market. This video covers the general provisions for imports, financing options, foreign exchange facilities, duty drawback schemes, foreign currency account management, custom clearance formalities, and shipping requirements, providing a detailed understanding of each aspect of import process. The first one is the general provisions for imports. The general provisions for imports provide the foundational framework for bringing goods into the country, outlining the essential guidelines, regulations, and compliance requirements. In India, imports are governed primarily by the Foreign Trade, Development and Regulation Act 1992 and the Customs Act 1962. Importers must be registered with an Importer-Exporter Code, that is IEC, issued by the Directorate General of Foreign Trade, DGFT. This registration is mandatory for engaging in cross-border trade activities and ensures that all import activities are properly monitored and regulated. To ensure safety and compliance, the import of certain goods may be restricted, regulated, or prohibited depending on the nature of the goods and the current trade policies. Prohibited items such as banned pharmaceuticals or hazardous materials cannot be imported. Restricted items like electronics, this may require specific licenses or permits, while other goods may only be imported under particular conditions. Importers must also comply with various quality and safety standards adhering to the regulations set by agencies such as the Bureau of Indian Standards (BIS). These standards help protect consumers and ensure that imported goods meet local requirements for quality and safety. Let's move on. We shall learn about financing import transactions. Import financing is essential for businesses engaged in international trade, helping them manage the cost of purchasing goods from foreign suppliers and ensuring smooth cross-border transactions. Import financing enables companies to acquire the capital needed to fund their purchases, especially when upfront cash payments are impractical. Various financing tools and options allow importers to access funds, balance cash flow, and meet their payment obligations while minimizing financial risk. Let's see the types of import financing. Import financing generally falls into two categories: pre-shipment and post-shipment financing. Pre-shipment financing covers expenses before goods are shipped, while post-shipment financing is used to cover costs after goods have been shipped but before payment is received. The role of financial institutions, let's see how this is happening. Banks and financial institutions play a significant role in import financing. They offer tools like letters of credit, which is LC, which guarantee payment to exporters upon the fulfillment of specified conditions. Buyer's credit is another option where importers borrow from foreign financial institutions to pay suppliers, repaying the loan over an agreed upon period. Supplier's credit allows suppliers to extend credit terms to the importer, enabling the importer to pay for goods after receiving them. Let's see government support and schemes. In India, the government supports importers through schemes aimed at small and medium-sized enterprises, SMEs, helping them access affordable financing options. Then comes the initiatives such as the Export-Import Bank, Exim Bank of India, provide specialized financing services and promote trade. One of the most commonly used tools in import financing is the letter of credit, which is commonly known as LC. An LC is a guarantee from the importer's bank to the exporter's bank that payment will be made once specific conditions are met, such as the shipment of goods and presentation of the required documents. This tool provides security for both the importer and exporter, ensuring that the importer will receive the goods and the exporter will be paid. LCs are widely used in international trade due to the assurance they provide, especially for first-time or high-risk transactions. Another financing option is buyer's credit, which involves an importer securing a loan from a foreign financial institution to pay the exporter. This credit facility is generally arranged by the importer's bank and allows the importer to delay payment for a specific period, easing cash flow pressures. Buyer's credit is particularly beneficial for businesses that require a longer credit period and allows them to settle payment with their suppliers and receiving and selling the goods. Supplier's credit is another method where the foreign supplier offers credit terms to the importer, allowing them to make payments after the goods have been delivered. This credit is arranged between the buyer and the supplier, with the supplier bearing the risk of deferred payment. Supplier's credit helps the importer manage cash flow without immediate cash outflow, providing time to generate revenue from the imported goods before settling the payment. Apart from these, trade credit insurance is available to cover the risk of non-payment. This insurance protects importers if unforeseen circumstances provide or prevent them from paying or their imports, thus safeguarding their businesses from financial loss. In India, the Export-Import or the Exim Bank of India and various government schemes support importers, especially small and medium enterprises, SMEs, with competitive financing options and insurance products that ease access to international trade. Additionally, banks and financial institutions may offer pre- and post-shipment financing to cover expenses before or after goods are shipped, helping importers meet working capital requirements. By leveraging these financing methods, importers can strategically manage their cash flow, reduce financial risk, and build stronger relationships with foreign suppliers, ensuring successful and efficient import operations. Import financing is essential for businesses that need capital to purchase goods from foreign suppliers before they have generated revenue from their sale. Various financing options are available to importers to help manage cash flow, meet working capital needs, and facilitate transactions with international suppliers. Let's move on to learn foreign exchange facilities available to importers. The Foreign Exchange Management Act FEMA 1999 governs foreign exchange transactions in India, regulating the flow of foreign currencies in and out of the country. Foreign exchange facilities are critical to importers as they enable smooth financial transactions and compliance with international monetary requirements. The authorized dealers are the banks and other financial institutions act as authorized dealers for foreign exchange, providing services to importers such as currency exchange, issuance of letters of credit, and foreign currency loans. These dealers must comply with guidelines issued by the Reserve Bank of India to ensure proper oversight of foreign exchange transactions. Let's see the payment terms for imports. Import payments typically follow specific terms such as DA, that is Documents Against Acceptance, or DP, Documents Against Payment. These terms dictate when and how payments are made, with DA allowing deferred payment and DP requiring payment upon receipt of goods. RBI guidelines on foreign exchange transactions includes the RBI regulates foreign exchange transactions, setting limits on foreign currency holdings and monitoring transactions to ensure compliance with FEMA. Importers are required to follow these guidelines to avoid legal issues and maintain smooth import operations. Foreign exchange facilities are essential for importers to manage cross-border payments efficiently and in compliance with international trade laws. In India, foreign exchange transactions are regulated by the Foreign Exchange Management Act FEMA 1999, which governs all currency exchanges related to trade and investment. These facilities help importers acquire and manage foreign currency to pay international suppliers, hedge against currency risk, and meet other financial requirements tied to global trade. One of the main foreign exchange facilities for importers is access to authorized dealer. We call it as AD banks. Okay? These banks are authorized by the Reserve Bank of India RBI to handle foreign exchange transactions, making it so easier for importers to exchange rupees for foreign currencies and conduct international payments. These AD banks provide essential services such as issuing letters of credit, that is LCs, in foreign currency, facilitating foreign currency loans, and converting currency at competitive rates. Importers can rely on these banks to navigate complex international payment procedures in a compliant manner. Importers can also benefit from foreign currency loans, which help them finance import transactions without immediately converting large amounts of Indian rupees into foreign currency. Through instruments like buyer's credit and supplier's credit, AD banks facilitate loans from overseas financial institutions. These loans allow importers to defer payments to foreign suppliers, offering more flexible repayment options and favorable interest rates. Another important aspect of foreign exchange facilities is the ability to open foreign currency accounts within India or abroad. In India, importers can open exchange earners foreign currency EEFC accounts, which allow them to hold a portion of their export earnings in foreign currency. This reduces the need for constant currency conversion, enabling importers to use foreign currency directly for future imports. Holding foreign currency also helps mitigate exchange rate fluctuations, risks, making it easier to manage costs when the rupee value changes against other currencies. The RBI has also provided guidelines on permitted currencies and approved payment methods for import transactions. The commonly used currencies include the US dollar, euro, and British pound, among others. Payments can be made through various approved channels, including SWIFT, that is Society for Worldwide Interbank Financial Telecommunication Transfers, real-time gross settlement, we call it as RTGS, and National Electronic Funds Transfer, NEFT. These methods ensure that transactions are secure, efficient and compliant with international standards. For managing currency exchange rate risks, importers may use hedging instruments such as forward contracts and options, allowing them to lock in exchange rates for future transactions. These instruments, facilitated by banks and financial institutions, protect importers from adverse currency fluctuations, helping stabilize costs and maintaining profitability. In summary, foreign exchange facilities for importers offer essential support for managing international payments, minimizing currency risks and adhering to compliance requirements. By using these facilities effectively, importers can optimize cash flow, reduce foreign exchange volatility and conduct cross-border transactions efficiently and securely. Let's move on to customs and central excise duty drawbacks for exported goods. The duty drawback scheme is a government initiative designed to encourage exports by refunding customs and central excise duties on imported goods that are subsequently exported. This refund process helps reduce the overall cost of goods, making exports more competitive in international markets. Customs and central excise duty drawbacks for exported goods include the incentives provided by governments to encourage exporters by reimbursing duties paid on imported or domestically sourced raw materials used in the manufacture of export of goods. In India, the duty drawback scheme, managed by the Directorate General of Foreign Trade (DGFT) and governed by the Customs Act 1962, plays a crucial role in making Indian exports competitive in the global market by offsetting additional costs. Understanding the drawback mechanism is the duty drawback mechanism operates by refunding duties and taxes imposed on raw materials, components or intermediate goods used in the production of exporting of products. These taxes include customs duties on imported raw materials and excise duties on domestic inputs. By reimbursing these costs, the government reduces the effective cost of production, enabling exporters to offer their goods at more competitive prices in the international markets. Let's see the types of duty drawbacks. All industry rate, that is AIR, this is a standardized rate of duty drawback set by the Indian government, covering a wide range of products. These rates are predetermined annually by the government based on the average duties paid on inputs used in various export sectors. The AIR simplifies the process for exporters who can claim refunds without having to document the specific duties paid on each input. Brand rate of duty drawback is the All India industry rate does not cover the full amount of duty paid by an exporter. They may apply for a brand rate. Under this system, the exporter provides detailed records of the duties paid on specific inputs and the government calculates a custom rate based on actual input costs. This option is beneficial for exporters who use unique materials or complex inputs that may not be fully covered under the standardized AIR rates. Then comes the eligibility and procedure for claiming duty drawback. To be eligible for duty drawbacks, exporters must follow the regulations set by the Central Board of Indirect Taxes and Customs (CBIC). The key requirements include: exported goods must not be re-imported into India for a specific period after exporting. Exporters must submit the required documents such as the shipping bill, bill of entry and duty drawback statement to prove that duties were paid on inputs and that the goods were exported. The claim process generally begins with the submission of a duty drawback claim within 3 months from the export date. Claims can be filed electronically through the electronic data interchange, we call it as EDI system, which speeds up processing and reduces the paperwork. Relevance and impact on exporters' customs and central excise duty drawbacks includes a positive impact on the competitiveness of Indian exports. By refunding duties, exporters can reduce their overall cost structure, enabling them to price the products more attractively in the international market. This scheme is especially beneficial for sectors such as textiles, electronics and manufacturing, where a significant portion of the production cost comes from duties on imported materials. In addition to promoting exports, the duty drawback system incentivizes manufacturers to increase production capacity for international markets, boosting foreign exchange earnings for the economy. The scheme also helps in building a strong base of export-oriented industries, which contributes to overall economic growth and job creation. Let's see the challenges and compliance considerations. Despite its advantages, the duty drawback system involves compliance and complexities. Exporters must maintain accurate records of duty payments and exports to qualify for refunding. Any discrepancies or documentation errors can lead to delays in receiving the refund, or in some cases penalties also. Additionally, periodic revisions in AIR rates and complex eligibility criteria can create challenges for exporters to stay updated and maximize their benefits. The customs and central excise duty drawbacks serve as an essential mechanism for supporting export competitiveness in India. By reimbursing duties on inputs, the government reduces the cost burden on exporters, fostering a favorable environment for international trade. However, exporters must navigate regulatory requirements carefully to take full advantage of these incentives, ensuring that they maintain compliance while optimizing cost savings. Let's move on to learn about foreign currency accounts in India and abroad. Foreign currency accounts are critical for importers and exporters managing international transactions. These accounts allow businesses to hold, receive and pay in foreign currencies, facilitating smoother transactions and minimizing currency conversion risks. Let's learn about the types of foreign currency accounts. There are several types of foreign currency accounts available of individuals and businesses in India and abroad, each catering to specific needs and requirements. The features are EEFC accounts can be held in major foreign currencies such as USD, Euro, GBP, etc., and no interest is typically paid on these accounts. The benefits includes the accounts help exporters manage exchange rate fluctuations, as they can pay for imports and other foreign expenses directly from the account without conversion. RFC accounts can be maintained in foreign currencies, and in some cases they earn interest also. These accounts provide an option to hold funds in foreign currency for future use abroad or to hedge against the currency depreciation, offering flexibility for those planning to work abroad again or having a foreign financial obligations. The features include FCNR accounts are term deposit accounts that can be held in specific foreign currencies and they can earn interest also. Then comes the accounts which will help NRIs to protect their deposits from rupee depreciation and allow for repatriation of funds without conversion. The exporters can hold a portion of their export proceeds in these accounts, typically for a specified period. The benefits include the arrangement allows exporters to manage working capital requirements and minimize currency conversion costs associated. These accounts can be opened in various foreign currencies based on the business needs in the host country. Continuing with the benefits, overseas foreign currency accounts help multinational corporations and large exporters manage local payments, salaries and other expenses more efficiently and avoid repeated currency conversion fee. The benefits of foreign currency accounts includes the foreign currency accounts offer several advantages for both individuals and businesses engaged in international transactions. The currency risk mitigation. By holding funds in foreign currency account, holders can avoid frequent conversions and protect themselves against exchange rate volatility. Then comes the cost efficiency. For businesses involved in import-export operations, foreign currency accounts eliminate the need for multiple conversions, reducing transactions fee and minimizing losses due to fluctuating exchange rates. Another benefit could be flexibility in payment. Exporters and importers can use foreign currency accounts to manage international payments efficiently, providing liquidity for global operations and facilitating timely payments. Repatriation of funds. This includes the accounts like FCNR offers NRIs the flexibility to repatriate funds without conversion, making them attractive for investment purposes while maintaining currency value. Then comes the regulatory compliance. Foreign currency account help businesses comply with FEMA regulations by offering structured ways to hold and transact in foreign currencies within India. Let's move on to learn about the permitted currencies and methods of payment. The RBI regulates the types of currencies that can be held in foreign currency accounts, typically focusing on major currencies like the US dollar, euro and British pound. Payment methods commonly used in international trade include SWIFT transfers, RTGS and NEFT. We shall continue learning about regulatory framework and compliance. In India, foreign currency accounts are governed by the RBI under the guidelines of FEMA. Compliance is crucial for both individuals and businesses to avoid penalties and ensure smooth transactions. Key points to consider: the permitted uses, which the type of foreign currency account has specific restrictions on usage. For example, EEFC accounts are designated for receiving export proceeds, while FCNR accounts are specifically for NRIs. The limits on retention is set by the RBI on the retention period for funds in certain foreign currency accounts, requiring that funds be converted into Indian rupees if not used within the prescribed time frame. Let's see the documentation procedure and requirements. Importers and exporters must maintain proper documentation, including invoices, shipping bill and exchange control copies to validate the use of foreign currency accounts and support the audit trails. Interest and repatriation rules includes: the foreign currency accounts vary based on account type, correct? FCNR accounts offer interest while EFC accounts do not. Additionally, repatriation of funds for accounts like FCNR is allowed subject to regulatory approval and compliance with the tax laws. Foreign currency accounts provide valuable financial tools for individuals and businesses operating in the global marketplace. By offering facilities to hold and manage foreign currency within India and abroad, these accounts enable Indian exporters, NRIs and globally operating companies to manage currency risks, enhance financial flexibility and optimize international transactions. Compliance with FEMA guidelines and RBI regulations is essential to leverage these facilities effectively, ensuring that account holders maximize their benefits while adhering to regulatory requirements. As India's global trade expands, foreign currency accounts continue to play a critical role in supporting international businesses and investment, fostering a more integrated global economy. Let's move on to learn about the customs formalities for clearance of imported goods. Customs formalities are essential procedures that ensure imported goods comply with national laws and regulations before they enter the domestic market. These formalities are critical to safeguard the economy, control quality and enforce trade policies, all while collecting revenue in the form of customs duties. In India, the customs clearance process is governed by the Customs Act 1962 and administered by the Central Board of Indirect Taxes and Customs, which is CBIC. The clearance process for imported goods begins with the filing of a bill of entry. We call it as BOE in short, which is a legal document that needs to be submitted electronically or in hard copy. This document details the nature, quantity and value of the goods being imported, as well as information on the exporter and importer. The BOE must be filed within 24 hours of the goods arrival at the customs port with all relevant supporting documents such as the invoice, packing list, bill of lading, import license and insurance certificate. Once the BOE is filed, customs officials inspect the goods to verify that they match the declaration. This inspection can be physical, documentary or both, depending on the nature of the goods and associated risk factors. In cases where goods are restricted or require additional permits, customs officers will verify that these conditions are met. Following inspection, customs duty, goods and services tax, that is GST, and any additional charges must be paid before goods are cleared. Once payment is complete, the importer receives a pass out order allowing them to collect their goods from the port. The customs clearance process ensures that all imports are legal, taxed appropriately and meet national standards. While streamlined in recent years with digital tools like the Indian Customs Electronic Data Interchange System ICES, the process remains essential to managing exports and imports effectively and safeguarding the country's economic and social interests. Customs formalities are essential for clearing goods imported into India, ensuring compliance with regulations and facilitating the movement of goods through customs checkpoints. Let's see the custom clearance procedures. Importers must complete specific steps to clear goods through customs, including filing the bill of entry, which is a declaration of the goods being imported. This document is essential for customs authorities to assess the goods value and also to determine the applicable duties and taxes. The key documentation required are: importers must provide several documents to customs authorities, including the commercial invoice, import license and packing list. These documents verify the shipment's contents, value and compliance with regulatory requirements. Let's see the inspection and quality checks for this system. Customs authorities conduct inspections to ensure goods meet quality standards and comply with import regulations. Inspections also help prevent the entry of restricted or illegal systems. Let's move on to shipment of goods and logistics in imports. The logistics and transportation of imported goods are fundamental to the import process as they determine how goods are shipped, stored and also delivered. Modes of shipment for imports includes: this can be shipped by sea, air or land depending upon the nature of the goods, cost considerations and delivery timelines. Each mode has its advantages and challenges, with sea freight being cost effective for bulk shipments and air freight suitable for time sensitive items. Shipping documents and their importance are: which needs the import shipments require specific documents including the bill of lading, packing list and certificate of origin. These documents provide details about the shipment, its origin and other necessary information for customs and import authorities. Let's come to learn about the insurance for imports. Insurance is essential to protect imported goods from potential risks during transit, such as damage or theft. Importers can purchase marine insurance, cargo insurance or other types of coverage to safeguard the investments. Custom brokers and clearing agents are also involved in this procedure. Customs brokers and clearing agents play a very crucial role in facilitating the import process, assisting importers in navigating customs formalities and ensuring compliance with regulations. How do we track and monitor shipments? Importers increasingly rely on tracking systems and technologies like GPS to monitor shipments, ensuring timely delivery and allowing for real-time updates on goods location. We are moving on to the next aspect. Learners, understanding and managing the import process involves navigating complex regulations, securing financing, handling foreign exchange, managing customs duties, and ensuring efficient shipment and delivery. For businesses, the ability to effectively import goods while complying with local and international laws is critical to maintaining competitiveness in global markets. By adhering to general provisions, securing appropriate financing, utilizing foreign currency facilities, and following customs formalities, businesses can streamline their import operations, reduce cost, and improve overall efficiency. Through continued focus on compliance, efficient logistics, and strategic financial management, businesses can leverage the benefits of imports to enhance their product offerings, meet consumer demands, and foster sustainable growth in the international marketplace. Hope you have learnt the methods of payment and customs formalities for clearance of imports and shipment of goods in Unit 4. There is an assessment link is enclosed. Please respond to the assessment to check your understanding of the subject. Thank you for joining this video.